Inflation has been an issue the past few years as prices seem to keep going up for groceries and real estate or eating out and travel. In 2022, inflation was up over 9%. As a response to inflation, the IRS releases new inflation-adjusted tax brackets. So today I'm going to break down the new brackets and then see how it impacts your retirement, and then look at strategies of how to actually use these changes to optimize your retirement. If I haven't met you yet, I'm Dave Zoller, owner of a tax firm and a retirement planning firm, and we've been helping a select number of clients over the last 15 years coordinate these two parts of their life so that they can keep more of what they make. Now, if you watch this video and you like it, please click the like button so that more people can get this info. Now, let's break down the concept of the 2024 tax bracket changes in a way that's easy to understand. Think of tax brackets kind of like a staircase. Each step represents a different portion of your income that gets taxed at a specific rate. And as you make more money, you climb higher in the steps, and each step has a higher tax rate than the one before. And what's happening in 2024 is that the IRS is adjusting these staircases, or really they're adjusting how much income fits on each one of these steps. Here's an example. Take Donna. So she's in retirement and she's taking a fixed dollar amount out of her IRA. Well, in 2024, because of the IRS adjustments, the money that she's taking from her investments is going to be taxed less than before. That's good. That allows her savings to stretch a little bit further. So I'll show you what the actual numbers, the updated numbers look like for single filers, and then I'll show you married filing joint, and then we'll go over some of the strategies to take advantage of this. So here are the updated tax brackets for single filers. And we can see that up to the first 11,600 is taxed at the 10% bracket. Then anything above this 11,000 all the way to 47,150, this is taxed at the 12% bracket. Now, a mistake that people sometimes make is they think when they get into the 12% bracket, all of a sudden, everything, including the first 11,600, is taxed at 12%, but that's not true. This 11,600 is taxed at 10, and then even if you move to the next one, it's just whatever is above the 11,600 that will be taxed at the 12% bracket. And then it keeps going up. There's really a big jump here from 12 to 22. And then there's a big jump from 24 to 32. And then the highest, as of right now, the highest tax bracket is 37%. And then when we look at married filing joint filers, it's significantly higher. So there's single. And then here's joint. And we can see similar numbers. All the tax brackets are the same, but just these dollar amounts are different here. So I'll give you a second to take a snapshot of this, and then also a snapshot of the single filers. And you could always pause and rewind if you need to see this. But then I want to move on to the strategies to actually optimize taxes in retirement, because we've got 5 different levers that we can pull when it comes to using tax brackets or using tax planning in our retirement withdrawal strategy. And these are big. Each one of these impacts how much tax you pay. As an example, let's take Jack and Bob. It's really 2 people. They could take out the same dollar amount from the same accounts within the same period of time, but one pays more tax than the other. Now, how can that be? It's because of the different levers that they pull. Or we could also call it the different ingredients. And I'll give you an example of these 5. It's really around timing the withdrawals or just the withdrawal strategies. Number 1, we should get clear on the tax treatment of each account. So we've got the taxable, right? That's like brokerage accounts, right? Or that could be money at the bank too. The interest is taxable each year. That's the 0 to 20% for most of the time. And then we've got pre-tax, and that's your IRA and 401k. Everything that you pull out of this is going to be taxed at ordinary income. And then we've got the post-tax. That's Roth. So this, essentially, everything you pull out is going to be, should be tax-free. Now, there's some rules and things, but tax-free money is what it's usually called. So now we're going to combine these ingredients, these types of accounts, with the timing of withdrawals. And here's what we'd see with these 2 guys, Jack and Bob. So let's pretend they both retire in June of 2024. So Bob, he starts using his taxable account first because he hears that in traditional retirement planning, use that first and then wait as long as possible to take your pre-tax money, like your IRA money or 401k. Let that compound. Now, depending on your net worth, that might not be the optimal thing to do. But anyways, in this example, he uses the taxable account and draws it down for a few years, and he's not paying a lot in taxes these years. And then later on, he starts using the IRA monies, and then he starts paying tax on all of those withdrawals. But then what Jack looks at, he takes a look and sees, okay, so they both have the same income this year, but they stop halfway through. So he uses taxable first year as well, and he withdraws from that, and what he finds out is that he's in a much lower tax bracket than normal. So he decides to start looking at Roth conversions. He's mapping out over the next few years, there's a point in the future where he's going to be forced to take out of his IRA monies and 401k monies when he's in his early 70s, and he's got to take the required minimum distribution. And he sees at that time his tax rate is actually in the 22-24% bracket. So what his thought is here is, might as well start getting money from IRA over to Roth now while he's in a much lower tax bracket. So he does that, and then in 2025, he decides to continue taking the taxable, meaning the brokerage account, and then continue this Roth conversion strategy this year as well, and max it out at the 12% bracket. Now, this is just an example. Another example is, say that there's going to be a business sale or real estate sale, something that will spike income in 2026. Well, Jack might use taxable income the first year, and then this year maybe he's using just IRA withdrawals. And usually the traditional tax or traditional financial planning would say save the IRAs for much later in life. But because he knows in the future he's got a big income increase, he doesn't want to use that in 2026. Well, he might use it this year, and then he'll use his taxable account or bank account later on in 2026. So there's different things that can happen here with, it really depends on your personal situation and what you have coming up in the future. But this idea of timing withdrawals and what account you're going to take out of is important. Now, we don't want to be always looking at, what account to pull out of at what time, but usually once per year, usually in the summertime when we do it for our clients, we'll look at the following year and decide, okay, here's the right withdrawal strategy from each account. And the end goal is that you can just sit back and receive the paycheck from your accounts without much work, have it be automatic, but you're really pulling it from the right accounts and it's happening automatically for that year. So hopefully this idea of paying attention to withdrawal strategy is sinking in a little bit. Oh, and another thing on timing. Say that you're making a purchase or a big trip is coming up next year, and you're going to use your IRA to fund some of that expense. Let's pretend it's one of those big expensive river cruises. Rather than waiting until that year to pull everything out of your IRA, maybe look at taking half of it out now, this year, and then half of it out later. December 31st is the cutoff, and that could be a difference of what tax bracket you land in based on how much you're taking out from your IRA or 401k. So now moving on, the other levers or ingredients to consider is really what tax deductions or credits you might have or might take this year. If this year is one where you've got any medical expenses that are going to allow you to deduct them on your taxes, or say that it's going to be a bigger gift than normal to charity that you can deduct. Take a look at how that impacts your tax bracket, because that can put you in a lower tax bracket. It might make sense to do a Roth conversion that year. If you're lower because of a big gift, you might lower your tax bracket down to whatever 10% tax bracket. Well, maybe you'll do a Roth conversion to get back to 12 or 22 or whatever it might be. The other lever that you can think about that impacts your tax bracket is the tax efficiency of the investments that you own. Because some mutual funds, they're tax inefficient, which causes you to recognize gains and get taxed even when you didn't sell anything. You know, we've had people come pick up their taxes who are not clients of Streamline. They've got a different advisor, but they pick up their taxes and they're shocked that they have to pay what they have to pay because their investments made a bunch of changes within the fund that caused them to shoot up to the next tax bracket. Now that can be avoided by paying attention to what investments you own. There's sometimes we call it the tax nasty funds versus the tax efficient funds. When we're in retirement especially, let's have the tax efficient funds. Now, if you want to see a specific example of how someone used these strategies in their plan, click on this video. It's an oldie, but it's a goodie, and it'll help you kind of get more of an idea of how maybe you can apply this to your specific situation. So I hope that was helpful. If it was, please like the video, and then I'll see you in the next one.